I want you to picture your investment portfolio for a second. Maybe you just checked it. You see those green numbers? Your 401k is up, what, 10, 15, maybe even 18% over the last year?
Feel good.
You feel good, right, like you're getting ahead. But what if I told you that was, well, a lie? What if, despite those green numbers, you actually lost a massive amount of your wealth last year?
It sounds a bit like a conspiracy theory, I know.
Yeah.
But it's cold, hard arithmetic. The numbers on your screen are going up, sure, but the value of the money itself is crashing.
We're looking at some...
And that really is the bottom line, isn't it? That's the conclusion we have to start with. The financial system is being reset. The dollar is being devalued to manage a debt that is, well, it's mathematically unpayable.
And it's not an accident.
Not at all. This is a deliberate policy choice. And if you don't understand how it works, you're the one footing the bill.
So our mission today is to unpack this. We're going to look at why the dollar is crashing against real money, like gold, why central banks are quietly dumping U.S. debt, and why your gains are actually losses. Let's just jump into the numbers, because honestly, when I first saw this data, I thought it was a typo.
It is startling. Let's start with this idea of the wealth illusion.
Right, so the big headline number, the one everyone cheers for, is the S&P 500. The latest data says it was up 18% last year.
Which in a normal world is a fantastic year. Everyone's celebrating.
Exactly. But that 18% gain is measured in dollars.
Right.
And that's the whole problem, right?
It's the whole problem. You're measuring your wealth with a ruler that's shrinking. To get the real picture, you have to measure it against something constant, something that can't be printed by politicians.
You have to measure it against gold.
You have to measure it against gold.
And this is where the aha moment just hit me like a ton of bricks. When you measure the S&P 500 against gold, it wasn't up 18%, it was down.
Down 28%.
Down 28%. I mean, just let that sink in.
That's a 46 percentage point gap, that gap. That is the inflation tax. It's the invisible cost of printing money. So you feel 18% richer, but you're actually almost 30% poorer in real purchasing power.
It's terrifying. It's like you're running on a treadmill that's moving backwards faster than you can run forward.
That's a perfect analogy. And just look at the currency itself. In a single year, 2025, the US dollar lost 39% of its value against gold.
39%.
A staggering collapse for the world's reserve currency.
If a tech stock dropped that much, there would be panic in the streets. But because it's the dollar, we just, I don't know, we complain that groceries cost more.
We call it inflation,
right,
but really it's devaluation. And it's not just against gold. The dollar's down 12% against the euro, 13% against the Swiss franc, 4% against the yuan. The whole world is repricing the dollar lower.
But gold is the one that really tells the story here.
Gold is the lie detector. It has no central bank. There's no CEO of gold who can just wake up and decide to print another trillion ounces for some new program. It's the measuring stick.
Yeah.
And right now, that measuring stick is screaming that the dollar is dying.
Okay. So we've established the crime scene. The dollar is bleeding out. Now we need to understand the motive. Why is this happening? The reports we're looking at call it a structural trap.
It is a trap, and the trap is built out of debt.
Yeah.
To understand why your savings are worth less, you have to look at the U.S. national debt. It's sitting at $38 trillion.
$38 trillion. It's a number so big it doesn't even feel real.
So let's look at the speed. That's what's really scary. The data shows the debt is growing by $6 billion. Every single day.
$6 billion a day.
Every day. Last year, the U.S. added $1 trillion in new debt in just 71 days.
71 days.
For context, it took the United States almost 200 years to rack up its first trillion. Now we do it in about 2 months.
That's just insane. But debt isn't free. You have to pay interest on it.
And that is the trap. The U.S. paid $1.2 trillion in interest alone last year.
$1.2 trillion.
That is more than the entire defense budget. We're spending more on the interest from past borrowing than we are on actually defending the country.
So this is the dilemma for politicians. They've got these massive bills. What can they do? I mean, normally, if I'm in debt, I either stop spending or I find a way to make more money.
Governments have the same basic options, even if they pretend they don't. They've really only got 3 choices. Option A, raise taxes.
Which, sounds logical. Tax the rich, right?
But look what happens in the real world. Look at the UK. They tried that. They raised taxes, to be fair. And what happened?
And wealthy left.
They left. They moved to Dubai, to other tax havens. The tax base shrinks, and government revenue actually drops. Capital is mobile. If you tax it too much, it just goes somewhere else.
Okay, so option A is out. What about option B, cut spending?
Political suicide. About 17% of the budget is just that debt interest. You can't cut that, or you default. So you're left cutting Social Security, Medicare, or the military.
And which politician is going to run on that platform?
Exactly. Vote for me, I'm cutting your grandma's health care. It's a non-starter. They'd be out of office before lunch.
So option A is impossible, option B is impossible. That leaves
Option C,
the printer.
the printer. You print the money, you devalue the currency. It's the path of least resistance, and it's effectively official policy now. The logic is simple. If you owe $38 trillion and you make each dollar worth half as much, suddenly that debt is much easier to pay back.
But the victim is anyone holding those dollars. It's the saver. It's our listener right now.
It's a quiet confiscation of wealth. They don't have to send you a tax bill. They just dilute the value of your labor and your savings. It's insidious because you don't see it happen directly. You just notice life gets more and more expensive.
This connects to something else in these reports that I found fascinating. This isn't just a domestic U.S. issue. This is global. They're calling it capital wars. It seems like the rest of the world is watching this debt train wreck and getting really nervous.
They are. And it's not just about the economics anymore. It's about geopolitics. Money has become a weapon. And to understand this shift, you have to look back to the turning point in 2022.
You're talking about when the U.S. and its allies froze Russia's central bank reserves.
Exactly. When Russia invaded Ukraine, the West kicked them out of the SWIFT system and just seized hundreds of billions of dollars. Now, forget the morality of the war for a moment. Just look at it from the perspective of a central banker in, say, Brazil, or China, or Saudi Arabia.
They saw that and they thought, wait a minute, if we ever get on the wrong side of Washington, our money could just disappear.
Precisely. It was a massive wake-up call about something called counterparty risk. If you hold your nation's savings in U.S. dollars, you're trusting the U.S. government. But if they decide you're an adversary, that trust means nothing. The money vanishes.
So the lesson for the rest of the world was, if you want to be a truly sovereign nation, you can't keep all your eggs in the American basket.
Correct. And we're seeing the reaction in real time. Countries like China, Poland, Brazil, Saudi Arabia, they are all actively diversifying away from the dollar. They're building their own payment systems to bypass the U.S. entirely.
And this brings us right back to gold. Because if they aren't buying U.S. dollars, what are they buying?
They're buying the one asset that is truly neutral. They're buying gold. Central banks are buying gold at record levels. It used to be about 4% of their reserves. Now it's climbing towards 9%, and it's accelerating.
There's one stat in the reports that just blew my mind. By 2026, central banks are projected to buy half of all the new gold mined in the entire world.
Just think about that supply and demand shock. Half the global supply is being vacuumed up by governments. Why? Because gold has no counterparty risk. It has no CEO. You can't freeze it. You can't sanction it. It's the only financial asset that both allies and enemies agree has value.
It's funny, isn't it? We're told gold is a barbarous relic, but the most powerful financial institutions on Earth are hoarding it like there's no tomorrow.
You have to watch what they do, not what they say. The smart money, the people running the system, are moving into gold because they know the paper system is creaking under the strain.
Let's talk about that creaking. We mentioned the debt, but there's a specific storm on the horizon the reports call the refinancing crisis. What does that mean for the average person?
This is the immediate danger. The U.S. government has something like $9.2 trillion in short-term debt that matured last year. It all has to be refinanced.
So refinancing is just getting a new loan to pay off the old one, like with a mortgage.
Exactly. But here's the problem. A few years ago, when they borrowed that money, interest rates were near zero. It was basically free money. Now rates are much, much higher. So they're replacing cheap debt with very expensive debt.
Which means those interest payments we talked about, the $1.2 trillion, that number's about to go way up.
Way up. It's a vicious cycle. They have to pay more interest, so they have to borrow more money just to pay the interest on the old money, which creates even more debt. It forces the Federal Reserve into a corner.
What can they do?
They have to try to lower interest rates or print more money just to keep the government solvent.
And the reports say the Fed's primary goal isn't price stability anymore. It's keeping the government running.
That's the grim reality. If the choice is between the U.S. government defaulting on its debt or destroying the value of your dollar through inflation, they will choose inflation every single time. That's what they call the price of stability.
And even if the Fed officially cuts rates, the market might just ignore them.
That's a key point. It's about psychology. If investors around the world see the U.S. as fiscally irresponsible, as risky, they'll demand higher interest rates to lend us money, no matter what the Fed said.
And that trickles down to all of us.
It trickles down to everything. Higher mortgage rates, higher car payments, higher credit card debt. The government's debt crisis becomes your family's budget crisis.
Okay, this is heavy. It's a lot to process. We've got the dollar devaluing, debt spiraling out of control, central banks fleeing to gold. The obvious question is, what can we do? What can the listener do?
The sources we're looking at are pretty specific here. The main strategy is to basically align yourself with what the central banks are doing. Ray Dalio, for instance, has suggested holding somewhere between, say, 5 to 15% of your portfolio in gold.
Kind of like an insurance policy.
Exactly. It's diversification against the paper system.
Okay.
If that system takes a major hit, you want an asset that tends to move in the opposite direction.
Now, I know a lot of people are immediately going to ask, what about crypto? What about Bitcoin? The source material had a very specific take on this.
It was skeptical, yeah. While Bitcoin is often called digital gold, the argument here is about traceability and history. In a capital war, governments want control. Crypto is a digital ledger. It is fundamentally traceable. Gold is physical, it's private, and has a 5,000-year track record. The source definitely prefers physical assets that are outside that digital dragnet.
So if someone is listening and wants to get into gold, what are the options the reports laid out?
There are three main paths. First is physical gold, coins, bars. The big benefit is you hold it, you own it. The downside is storage. You don't want to keep your life savings under your mattress. So you need a safe or a vault.
Okay. And then there are ETFs, like GLD.
Right, that's the easiest way.
Yeah.
Just like buying a stock.
Yeah.
But you introduce that counterparty risk again. You're trusting a fund manager, a custodian. If the system truly breaks, that paper gold might not be as safe as physical gold.
And the third option was mining stocks?
Higher risk, but potentially a much higher reward. It takes, 16 years to open a new gold mine? So supply is very constrained. If the price of gold skyrockets, the companies that pull it out of the ground can see enormous profits. But again, it's volatile. You have to know what you're doing.
The big takeaway for me was just the urgency. That gap we talked about between gold returns up 65% by some metrics and stocks at 18%, that shows the trend. The smart money is already on the move.
The window is closing. Usually by the time the mainstream news is shouting about a crisis, it's already too late to protect yourself. The central banks are positioning themselves now for a world where the dollar is worth a lot less. If you wait until the panic starts, you're going to be buying at the top.
It really feels like we are living through a historic reset. This isn't just another business cycle. It's a fundamental change in the world order.
We are. The debt is simply too high to be paid back in real terms. It must be inflated away. That is the only mathematical solution left. The gains people think they're seeing in the stock market are largely an illusion caused by a collapsing currency.
It's like measuring your height with a ruler that's shrinking. You think you're growing, but really the ruler's just getting shorter.
That's the perfect analogy.
So, here's the provocative thought I want to leave everyone with today. We spend our entire lives working for paper money. We save it, we stress about it. But the actual people who run the financial system, the central banks, they're dumping that paper and buying physical gold.
If the architects of the system don't trust the paper, why are you holding 100% of your wealth in it?
That is the question. We'd encourage you to look at the real value of your assets, not just the dollar price. Stay curious, stay skeptical, and maybe take a look at what's really in your portfolio. Thanks for diving in with us.
Be safe out there.